macro market trends, stock selection, ETFs, options. Just some of the topics covered in Cook's Kitchen.
Welcome back to Cook's Kitchen. After a 2-week layoff due to some illness and general laziness, I'm back sporting my grizzly Thanksgiving beard. Speaking of grizzlies, before we get to gold, oil, or gold bonds and the Japanese yen, let's talk about the current bull market. I want to frame this in 3 ways. First of all, you have to know the state of the market. It's clearly bullish. You want to stay bullish. Obviously, you want to have your short-term strategies to deal with generally just being cautious in case there is a pullback you don't want to get caught in. But if you're a longer-term investor, and you're picking quality stocks, you want to stay in this. You don't know if the S&P can, still push on to 1900 before we get a 10% correction. Now that brings up the next point. How do you prepare for a correction? Again, if you're a longer-term investor and this is money you're putting away for 5-10 years, maybe you don't even worry about the correction because you don't want to miss out on the next 10 to 15% of upside. As market timers and short-term traders, we try and play this. We allocate accordingly. We remain cautious, cautiously bullish, and then maybe we're trying to time that turn. But you're never going to time it perfectly. You're going to take a hit of some kind. The question I want to ask is, let's look at the big picture for a second here. I've got a chart from a small RIA called J. Lyons. They made this going back to 1930, looking at comparing secular bull and secular bear markets when the Dow is pushing an extreme. And one way to define an extreme in a quantitative way is using Bollinger Bands. Remember, those are 2% standard deviation bands, 2 times the standard deviation over a 20-period moving average. So they're looking at monthly closes here on the Dow where you closed above the standard deviation Bollinger Band. Now, what happened during secular bear markets? The point they're trying to make here is you look at back in the 40s, this led to a further decline before the new secular bull market began in the 1950s. Then here's the next secular bear. Yeah, a couple of times in November and December of 1972, you got a couple of monthly closes above the Bollinger Band, the upper Bollinger Band. And what did that lead to? It led to your 1973-74 bear market, right? Which, we still didn't even, start the bull market until 82. So secular bull, 82 to, 2000. And so then the next instance they talk about is in an 11-month period at the last peak, going into 07, there were several monthly closes above the upper Bollinger Band. And what did that lead to? Well, right there. So here we are again. This is what they're trying to point out. During a secular bear, notice these are their examples, secular bears, the 40s, 70s, and assuming we're still in a secular bear now, are we reaching this frothy extreme with the Dow closing over the monthly Bollinger Band, and does that mean we're headed for a big drop? Now, a couple of questions to answer there. Are we still in a secular bear market? I'm going to tackle that next week. We'll dive in depth to that. But this is something you want to take a look at. If you're not familiar with Bollinger Bands, go on stockcharts.com, read the tutorial there, and then play with them on at least a daily or a weekly closing basis. All right, now let's get to gold and some other fun stuff. All right, here's a gold chart. This is going back to 2008. I had to cut off the timeline on the bottom, but this is 2008 when gold first touched 1,000. 2009 here. Here we are right now, breaking down. We're short gold for market timer, looking to test this low at 1180. And I think it will crack that low. 1155 is a pretty significant level. I'll come back to that in a minute. Let's take a look again at 2009. So this is 2009 here. I became finally bullish on gold. Had always thought it was the barbarous relic, not useful. But when it broke above, really had this breakout above, say, 1,025, I became bullish on gold. And in fact, I was on CNBC in the fall of 2009, stating my position. I was on Maria Bartiromo's closing bell, and I made the case that gold could go to 2,000, if it was viewed as a monetary phenomena. In other words, you've got central banks printing like crazy and debasing their currencies, and so gold becomes a significant store of value against currency debasement. And if you actually, took all the new dollars being printed and wanted to equate them to gold, then that would naturally drive gold's price up. Well, in 4 years, we got to almost 2,000, 1,900. So here's the top at 1,900. Now, let's talk about this 1155 level. It was a low in 2010. This would be the flash crash right here, May of 2010, which led to, and there was also, there was Greece fears then too, which led to a correction in the stock market, and things bottomed in June. That's also about where gold bottomed at 1155 in 2010. And so what we've got here, so that's why 1155 is significant for one reason. Now, on this chart I have a Fibonacci is drawn from the 2008 lows, just below 700, all the way to the peak at 1,900. The 61.8% retracement comes in at 1155. So that's why 1155 is significant on gold. Who knows, we may take that out. We remain short gold with a special ETF that we use. We made, the last time gold dropped 17%, we used a double short ETF and we made 35% on that. And maybe we'll do it again. All right, let's go to the yen, then we'll go to interest rates. This is a very long-term picture of dollar yen. This goes back to the mid-90s, yeah. And this is when I was trading dollar yen, all through this period here when it was up as high as 140, and throughout I traded it right up until 2008, along with the euro. I'm showing this longer-term picture just to give you an idea of where dollar yen has been. Here's the big run-up that we've had this year, and we have been long dollars, short yen through a special ETF we use, and made a little bit of money on a move in here. But you see this consolidation happening. This has become sort of a one-sided trade where a lot of the big institutions and hedge funds are long dollar yen, meaning they're short the yen. Now, why is this becoming such a popular trade? Well, it's all about interest rate differentials. Currencies are always about the difference in interest rates between the two countries, and not just the static difference, as in a carry trade. Like if you can say the Australian dollar's at, in 2009 when the Australian dollar was still had short rates above 3% and we come down to 0, that was a great carry trade, and that's why the Aussie ramped up so huge, tacked on 15, 20 cents in a matter of less than 2 years because of that interest rate differential. But it's also not just the magnitude of that carry trade opportunity, but also which way is it heading. And right now, the idea is that the interest rate differential between Japan and the U.S. is expanding, as it naturally should, because we're moving from a period of extremely low rates to one of potentially rising rates. And we've already seen that. Even though the short rate is very low, the 10-year has gone from, let's say 150 up to 3%, and it now keeps challenging that 3% level and sort of living in this 2.5%, 3% area, hanging out around 275 right now. So, this is what's driving dollar yen higher, is that spread widening in what are expected to be, say 2-year interest rates. That margin is going to widen between the U.S. and Japan, just because Japan is still doing their own quantitative easing and will stay stuck there because they are not going to have the kind of growth that we're going to have, and our rates are probably going to move faster. So back to the dollar yen chart. I'm looking for 110 sometime, in the next 6 months on dollar yen. But it's not going to be a straight path. Again, as I said, it's a crowded trade. A lot of people want to be short yen, small speculators, large speculators. So we stayed patient with this. We got back in, say 97, 98, and had to stay patient with it. We just got a nice move up here, and dollar yen has been to 102. could go to 110. All right, let's talk about rates. This is the yield on the 10-year. TNX is the quote, the ticker, going back to 06. I borrowed this from a trader buddy of mine. He says, if you haven't bought something with low interest rates yet, things may start to unravel even as the Fed says otherwise. Now's the time, right? If you haven't bought something with low interest rates. This is obviously corporations are aware of this. You've got IBM able to issue bonds or notes at 1% and buy things. Many corporations are borrowing as cheaply as they can. So here's the territory we're in. Where is the 10-year headed? Is it going to go? Are we going to break out above 3%, or is it still going to bounce around in here? 250, 280. This is the killer question, and we trade a 2 times inverse Treasury ETF in Market Timer, and we make some money there. It's like an ATM for us because we've had 10 out of 11 winning trades, and we're just timing the 10-year yield using this ETF to do it, and just taking small pieces here and there. So what's my forecast for interest rates? Well, I think say by middle of next year we could see 3.5% on the 10-year. But again, that's not going to be a straight line either. And you're still seeing people, the flight out of bonds. It's not become a rush for the exits yet. And so you still see some value in bonds, and bonds get picked up when that yield gets above 275. Buyers come in, and it's really all about the data, and it's not so much about the Fed. Even though we had this recent spike up above 280 as Yellen came in and wondering, what's going to be her stance as she was confirmed talking about, when does she pull the plug on bond buying? We found out, hey, she's a dove through and through, and probably not going to see a taper in December, although that one's not up to her. But we know the long-term path here. The Fed is not going to let this economy go. All right. So if you want to see how we play this in Market Timer, give us a try. We plan to keep trading it here, even if it goes below the 10-year goes below 2.5%. All right. Here's the other way of looking at this. This is TLT. This is like looking at the opposite of the 10-year yield. So just picture this as this is the long bond. What you've got here is something of a triple bottom since August, and as TLT rises, that's like bonds going up and yields going down. So if we have a shot here where this is a true bottom and investors are still clinging to the safety of U.S. Treasuries because they know rates are going to continue to stay low, you're going to see TLT above 105, 106, and you're going to see the 10-year yield back down to 2.5 or possibly lower. So those are the things we're looking at in Market Timer with gold, Treasuries, and the yen. And next week I'll be back and we'll try and answer that fundamental and awesome question: are we still in a secular bear market, or have we broken out? And is S&P 2000 around the corner next year? All right, thanks for joining me. I'm Kevin Cook.